Want to get rich like in 2008 and 2020? Smart money is doing this in 2025. You need to hear this if you're an investor. Watch out for July 2025 post-US debt outcome. The financial world is a symphony of interconnected parts, and sometimes the music turns discordant. We witnessed this in the 2008 financial crisis, triggered by a subprime mortgage meltdown. It sent shockwaves through global markets. Then, in early 2020, the COVID-19 pandemic delivered another blow, causing an unprecedented economic shutdown. These crises remind us that financial stability is precious and can be fleeting. The Federal Reserve, America's central bank, took dramatic action in both crises. In 2008, it slashed interest rates to near zero and launched quantitative easing, a program of buying bonds to inject liquidity into the markets. Similar measures were rolled out in 2020, even more aggressively. The Fed's swift actions helped prevent a complete economic collapse, but the road to recovery was long and arduous. Today, alarm bells are ringing again. Inflation has been stubbornly high, prompting the Fed to reverse course. It had raised interest rates at a rapid pace, the fastest in decades from March 2022 to July 2023. This aggressive tightening is designed to cool the economy and tame inflation, but it carries risks. Higher rates could slow the economy too much, potentially triggering a recession. Eventually, the Fed enacted 100 basis rate cuts by December 2024, where it remains as of April 2025. The bond market, a cornerstone of the financial system, is showing signs of stress due to the recent USA tariffs policy. Bond yields have been rising as investors demand higher returns to compensate for the uncertainty of the tariffs. This volatility is causing unease, as it suggests investors may be losing faith in the Fed's ability to manage the economy smoothly. The bond market is like a giant slumbering beast, and when it stirs, everyone pays attention. Adding to the uncertainty is a weakening US dollar. The greenback, the world's reserve currency, has been losing ground against other major currencies. A weaker dollar makes imports more expensive, further fueling inflation. It also erodes the purchasing power of US consumers and businesses. The US government's rising debt is another concern. The national debt has ballooned in recent years, fueled by tax cuts, increased spending, and the emergency measures taken during the pandemic. A high level of debt can limit the government's ability to respond to future crises. It also raises concerns about long-term fiscal sustainability. Amid these economic headwinds, gold is gleaming brightly. Historically viewed as a safe haven asset, gold tends to shine when the economy falters. Investors flock to gold during times of uncertainty, seeking its stability and potential for price appreciation. The precious metal acts as a hedge against inflation, as its value tends to rise when the purchasing power of paper money declines. Recent years have witnessed a resurgence in gold's appeal. After a period of relative calm, gold prices have been climbing steadily. This upward trend is driven by a confluence of factors, including geopolitical tensions, rising inflation, and concerns about the global economic outlook. For investors seeking a safe haven for their assets, gold offers a compelling option. It's a tangible asset with intrinsic value, unlike paper currency, which is subject to government manipulation. Gold's historical performance during periods of economic turmoil further strengthens its appeal as a safe haven asset. Navigating today's economic landscape requires prudence and a long-term perspective. Diversification, a cornerstone of sound investing, remains as crucial as ever. A well-diversified portfolio, spread across different asset classes, helps mitigate risk and cushion against market volatility. Maintaining adequate cash reserves is another prudent strategy. Having cash on hand provides flexibility and peace of mind during uncertain times. It allows investors to seize opportunities that may arise when markets decline and provides a buffer against unexpected expenses. The echoes of past financial crises serve as a stark reminder that economic stability is not a given. By embracing sound financial principles such as diversification and maintaining cash reserves, investors can weather the current storm and emerge stronger in the long run. The path ahead may be uncertain, but by making informed decisions and staying focused on long-term goals, investors can navigate the challenges and capitalize on the opportunities that lie ahead. With the outcome of the U.S. debt ceiling in July 25th, having standby cash is crucial to seize opportunities. Standby cash is essential to catch the bottom if quantitative easing by the Fed happens, as seen in 2008 and 2020. Don't forget to like, share, and subscribe for more grounded insights on markets, inflation, and smart investing if you like my video sharing content.